Good afternoon, everybody, and welcome to another Hamilton Wealth Partners Fund Manager webinar. My name is Kane Barano, and I'm a principal at Hamilton Wealth Partners. I'll begin this webinar by reading a brief advice warning and then introduce our two guest speakers and hand over to them for about 20 minutes. We'll then open up for questions at the end, but feel free to submit any questions in the taskbar below throughout the presentation. So the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking into account your objectives, financial situation, or needs. You should, before you make any decisions regarding any information, strategies, or products mentioned in this webinar, consult your advisor to consider whether that is appropriate, having regard to your objectives, financial situations, and needs. So today I'm joined by Nicole Connolly and Jonathon van Rooyen from Infrastructure Investment Partners Fund, or IPIF for short. So Nicole has over 20 years experience in the superannuation and funds management industry. Prior to establishing IPIF in 2015, Nicole was a director of alternative assets at Russell Investments and head of alternative investments at Telstra Super, one of Australia's largest corporate superannuation funds. Jonathon also has over 20 years of experience in the infrastructure investment sector. Prior to joining IPIF, Jonathon was the portfolio manager for a $2.5 billion unlisted infrastructure fund with assets in Australia and the UK. I'd now like to hand over to Nicole and Jonathon to give us some background on IPIF, their investment process, how they're dealing with the current COVID environment, and also where they're seeing the sector moving forward. So over to you, Nicole and Jonathon.
Great, thank you, Kane. We appreciate the opportunity to come to you direct via webinar today and let you know more about IPIF and how it's performing in these unprecedented times. Just as a background to IPIF and how it was established, the firm was established about 6 years ago to allow non-institutional wholesale investors access to unlisted infrastructure. Today we have approximately 200 million of funds under management, and that's invested in 4 underlying open-ended infrastructure vehicles, which provides exposure to 31. We have approximately 500 underlying investors in the fund. Jonathon and I are equal partners in the business and have very complementary skill sets. As Kane mentioned, my background is in superannuation and asset consulting, where I largely provided research function in the alternative asset space, and that included unlisted infrastructure. That background is well complemented by Jonathon, who has worked in the infrastructure sector for over 20 years, first as an asset infrastructure valuer and then as a portfolio manager for one of the largest global unlisted infrastructure firms globally. So I might hand over to Jonathon to just give a more background into information on his background and experience.
Thanks, Nick. I think so it's probably my pertinent sort of description would be, from my perspective, is a background on the valuation side. What are each of you investors really concerned about today in today's environment? Is what is the value of my unit in IPIF and indeed in unlisted infrastructure, particularly about airports, which we'll come to. And I think, so having spent 10 years at KPMG Corporate Finance, sort of grew up in a valuation environment, valuing the likes of these assets for unlisted infrastructure assets for the likes of AMP, Babcock and Brown at the time, Macquarie, and then IFM, Hastings, Colonial, etc. So have a broad understanding of importantly how those valuation processes work. And I think the often misunderstood robustness of the actual valuation process as it relates to determining the value of an unlisted infrastructure asset. So spent a lot of time there, and then obviously worked directly for a fund manager, and then we ran assets and sat on boards as well, for example, that in situations where the board approves the annual budget, which then in turn goes into the valuation, which again is adopted by the likes of IPIF to strike a unit price. So I could talk upside down under wet cement about valuation, and happy to take you guys or anyone who's interested in a more deeper context. But I think one of the things that really sort of excites us about this portfolio of 31 infrastructure assets is that very issue around the valuation process. And I think what we're seeing is a low volatility story coming through because of the underlying assets and the robustness around the cash flow, but also the process that is wrapped around determining what that's worth.
And that's actually a good segue into our philosophy and process. So what we do is adopt a bottom-up analysis of all the underlying assets in the portfolios we invest in or are prospectively going to invest in, to understand the income and capital profile, and importantly, the risk to the income profile of those assets. So question one is that risk to the income related to the regulatory profile of the asset, or is that risk to the asset, to the income related to volume? Is it volume driven? So it's really about achieving asset diversification as it relates to the risks around the income that each of these assets produce and provide. We largely look for mature assets with a long-term operating history or profile, as well as assets with long-term concessions and long-term contracts in place. And it's often these long-term concessions that underpins the performance of these assets, and Jonathon can certainly talk about that in a bit more detail. Our DNA as an investment manager is in the management of these assets in unlisted infrastructure, as well as manager research and portfolio construction as it relates to our respective careers, if you like, and experience. So really we bring this into the portfolio construction approach to our investments. The other point is that, I guess, interestingly, if you were to look at these funds on an individual basis and invest in any of the underlying funds that we invest to on an individual basis, you're not really going to achieve the same level of diversification you actually do require in this asset class. The funds are often not overly populated. They typically have between 10 and 15 assets each. And often they have a large single exposure to one particular asset. So we think this is the best way to get exposure to an optimal portfolio in this space. Jonathon, I'll hand on over to you for any additional comments on our philosophy and process.
Yeah, I think that really, Nick's touched on an important point. IPIF's probably the most diversified unlisted infrastructure platform around. Well, it certainly is in the case of accessing that sort of non-institutional investor, but with 31 assets split sort of 60-40 between airports, which we'll come to because they'd be the front of mind for most of us now, particularly, I'm based in Melbourne and the lockdown, we'll talk to that in due course. But 31 assets, 20 of those investments are regulated assets, the likes of Transgrid, Sydney Desalination, Electronet in South Australia, delivering a very stable, consistent cash flow that is somewhat, COVID agnostic, if you like. So where the portfolio, and that wasn't by design, no one's designed anything for COVID, obviously. But you can actually see that with the assets and how they're performing in this environment. And in terms of how we look at the portfolio going forward, we continue to explore assets which can withstand some of the shock events that we're seeing today. And so a little example is we're looking at some of the telecommunications stuff that's leveraged to 5G. We've got a very exciting platform that we're looking at there, and we'll continue to explore opportunities around data centers, fiber, spectrum, and so on, and see how what we're calling new infrastructure, or it's actually the infrastructure we're all sitting in front of right now using, where some of that can be adopted in the portfolio. Is that okay, Nick?
Yeah, no, I think that's great. Is it a good time to perhaps move to how COVID has impacted the current portfolio and the exposure to airports within the fund?
No, good segue. So 40 cents on the dollar of IPIF unit is airports. We own 6 of the top 10, and it's no surprise that it has impacted us. Back in March, we acted quickly, along with the underlying managers. So the impairments were around 10 to 15%. Those impairments were taken in the March quarter. We spent a lot of time in terms of the impact of COVID in the subsequent quarter to 30 June, talking and working with the valuers around really right-sizing those capital structures to ensure that, I mean, the first thing I think we learned from the GFC was where you had facilities and debt facilities and so on in that extraordinary that economic crisis, if you like, was to ensure that capital structure was sound. So in most cases, the airports, for example, drew down on their various facilities to ensure they had the cash to withstand the coming challenges. And all of them have successfully negotiated their capital structure arrangements with the various the banks and lenders, so that they're in good shape for the next 12 to 18 months. In terms of performance, the first half we had from 30 June or 1 July 19 to 31 December, the fund did around 8.5%. We distributed a 1.8% distribution. And then in the second half, obviously, we've had the COVID impact. What's happened in a 12-month, effectively for the 12-month period, we've had a flat return. So the first half has been offset by the impairments around the airports in particular, which has effectively offset the first half year performance. So we've had effectively a flat return for the 12 months, which has been, interestingly, we've still managed to distribute a 4% cash yield over the 12 months. Impairment is slightly higher, but it's a neutral return if you think about your unit price over the 12-month period. So that's what we've done in terms of the COVID impact. Moved quickly, worked closely with the managers, worked interestingly closely with the valuers, given our respective experiences, ensured that those. So effectively, from 1 July, as we sit talking today, the unit price of IPIF and your investment reflects, on a forward-looking basis, reflects the impairments that were taken to account for the impact of COVID. Another example is, we talk about, someone asked me, well, Jonathan, what about the second wave? The second and third waves are also taken into account as part of those impairments. And I'll give you an example. In the passenger numbers on a forward-looking basis, as it relates to domestic and international travel, on domestic travel, it's assumed in the forecasts, which is again reflected in the unit price, that the normalization, so that the passenger numbers only return to pre-COVID numbers in around FY 2023, 2024, in the case of domestic. So we assume in 21, 22, and until the end of 23 that there'll be that the passenger numbers will be materially lower than they were pre-COVID. Similarly, for international, we're not assuming to return to normal packs out into 2025, 26. So that wedge of value, if you like, has been stripped out of the forecast, and so the unit price has been reset. And that's why when we talk to investors and prospective investors, we talk about really what we're looking at now is a low point in the valuation cycle following those impairments and write-downs.
It's probably also worth adding that in terms of the forecast, the valuers or what they've forecast in those numbers, they've actually forecast that they never, as Jonathon mentioned, they never get back to pre-COVID levels, and in fact are roughly 10% lower. So they never ever get back to the levels we achieved pre-COVID. So I think that's sort of an interesting observation, and it also shows the conservatism that the valuers are adopting here for potentially a new way that people will travel going forward. And the reason with the way we look at the airport sectors, we have 11 airports across the country. Diversification of those airports, but they also have different levers and different drivers of earnings. Although they have the regulated aeronautical component, they're obviously all driven by passenger numbers going through the airports, but there's a mix of business-related recreational travel in those airports, even FIFO type travel for the airports that we hold in WA. And the WA airport exposure not only includes Perth, but also includes Port Hedland. So, and the other interesting observation that we've seen over the last 6 weeks, in fact, 8 weeks, is when the managers, these assets were revalued and airports and borders started to open up, we actually saw some of the Brisbane airport trade ahead of reforecast numbers. Now that was until Melbourne went into lockdown and in second wave, but it shows that, to Jonathon's point earlier, that these numbers do have taken into account the potential of second, third waves and address the risk that we see in the market today.
Thanks for that, Nicole and Jonathon. You touched on the regulated and unregulated mix of the assets. Are you able to maybe expand a bit on why you've taken this position and the risks that are around, that are present in both regulated and unregulated assets?
It's probably, thanks, Kane. I think it's a really topical and interesting question, but it probably is better to put it as fully regulated or partially regulated assets, because the partially regulated assets we currently have in the portfolio are roughly about 50%. So some of these partially regulated assets include airports. So it's where they've got a component of regulated revenue. We've got 25% of the portfolio in fully regulated assets, and they are typically the utilities, where there's no link to volumes or GDP growth. So that's the big poles and wires in New South Wales, Transgrid, Electronet, Sydney Desalination Plant and the like. And then the remainder of the portfolio is, I think there's roughly, I've got the numbers here, 8% in contracted, long-term contracted assets, and then roughly 13% that are volume exposed to volume risk. So we'd like to have most of the portfolio, in fact, up to 70 to 80% in the portfolio in partially and fully regulated assets. This is where we get certainty of income for a period of time. In the case of the regulated assets, the regulator approves an allowable return for the operator to earn over a 3 to 5 year period. So that's the base return you'll get on these assets. And you typically you earn more than that because they have efficiencies in how they operate, and it's typically quite higher. But as an example, it's usually above 6% as a base. So I think that's sort of how we look at the regulated and the unregulated mix. Jonathan, is there anything to add there?
Yeah, I would just say the other point on the regulated, the fully regulated that Nick's just covered there, you know, for example, Transgrid and Sydney Diesel, those assets are very typically quite high yielding, certainly in the case of Sydney Diesel. So we're quite attracted to that yield. We want to balance the growth, the capital growth side as well with delivering a consistent cash yield. And I think 2020 has shown that we can still deliver a yield in what was fairly extraordinary set of economic circumstances. So we'll continue to look at where we can, because we know the profile of our investors, you know, obviously wants that yield component. So we'll continue to really try and aim to deliver that. I think we're going to see softness in the next 12 to 18 months around the yield side, particularly from the airports. But that said, those regulated assets will deliver that yield component, which and we'll continue to explore going forward where we can look at strong yielding underlying investments.
Great, thanks for that. Oh, so did you want to add something, Nicole?
Oh, I was just going to say, in the case of Sydney Diesel, it's a good example of where you actually don't have to have it operating for the operators to earn a return. The government pay the operator simply to have it sitting available and ready to use if required. So it's the beauty of some of these assets.
That's a good point. Now I've got a question here from Stuart. He's asked, how have airports factored in the risk of fundamental change in the pricing model that airlines such as Qantas will seek? So that might be a question for you, Jonathan.
Yeah, we've obviously quite aware of the Qantas relationship, and I can tell you from my experience on the board of Gold Coast Airport, they are a formidable negotiator in terms of having to strike aeronautical agreements with the Qantas group. So the management teams at the underlying airports are very cognizant of the potential to change those aero agreements to something akin to a building block model, which is effectively, I think, where Stuart's question is. And that's, there's no surprise amongst the airport management teams that in terms of how they've priced their forward-looking reforecast, if you like, post-COVID, where they've done a shadow evaluation in terms of what that building block approach looks like in a I guess a new, what we'd call it, the new world, in terms of having to price agreements with effectively a major dominant counterparty such as Qantas, particularly as it relates to Australian airports. So short answer is yes. The asset management teams are aware of it, very aware of it at the underlying airports. The managers that sit around those underlying asset management teams at, say, Melbourne Airport or Perth Airport are equally cognizant of that dynamic, a potential dynamic. And then thirdly, I think really sophisticated shareholders, institutional shareholders such as the Future Fund with a 30% stake in Perth Airport are also obviously very aware of the potential shift and what that might do to unit prices and values, so that ensure that the forecasts that the management teams come up with in turn pass on to the value account of the risks of a changed model with the airlines.
Great, thanks.
Just to add to that, that's all right. Just to add to that, Kane, the airports, there's 4 revenue streams that the airports have. So the regulated aeronautical component, 25%. Then there's the retail, and that's retail on at the airport, as well as the property surrounding the airport. So it's retail property, aeronautical revenues, and car parking as well. So there's 4 different revenue streams, and they each represent about 25%. So the bit that Jonathon was just talking about there was the 20, it sits within the 25% aeronautical space.
And I think it's fair to say that it all comes back to a simple variable from the perspective of an airport valuation, and that is passengers. Quite simply, passengers drive all the 4 components that Nick just outlined. So ultimately, if you've got a sober view about the post-COVID recovery in the airline in passenger numbers, we think that's very much the starting point for the look forward valuation of each of these assets over there. The 25-year model that they are valued under, again, over that 75-year concession.
Great. So you spoke a bit about the diversification in the portfolio and, some of those newer type assets such as data centers. How do you balance the need for that further diversification with the opportunities that you're seeing in sectors such as airports and the depressed valuations there?
Yeah, it's a great question. Look, I think if we were sitting a year ago, someone approached us to see if we wanted to have a look at Hobart Airport, which was being transacted. That was sold bought rather 9 times EBITDA. That was around August last year. Fast forward to where we are today. Yes, so valuations have come back. There are some very interesting deployment opportunities for IPIF in relation to some of the underlying funds, which really are quite attractive. In fact, there's some interesting direct investment opportunities. But to your point, I think when you're 40 cents on the dollar in terms of portfolio today, airports, which we absolutely embrace, and I think it was and continues to be a real value proposition and differentiation for us. I think what we would say at this point is we're probably at weight. We're comfortable with those positions, and indeed we would. So that leads to then what else? And I think again back to the thesis of data of the fundamental shift and changes that we're seeing in how we conduct our lives, and indeed this whole forum, as I touched on before, that how do we get some exposures to those new type of infrastructures, and that's the work we're doing. I think what we've got to watch, Kane, is the pricing again. Back to my point, 29 times for a year ago for an airport, it would be a different price now. But similarly, we've had this pivot or this lurch to the left-hand side of the boat onto the tech. You can see that through the NASDAQ. So data centers are trading at significant premiums. We're seeing fiber and so on, and the infrastructure, the wall of money in the unlisted infrastructure world, really looking for a place in some of those new infrastructures, which is why we like the spectrum product that we're looking at now, because we think there's a genuine, a really A-grade manager who's very experienced in that space, and it's a I guess a misunderstood dynamic in terms of the demand supply. So to answer your question, we really think portfolio-wise we're in a good place. If we could pick up something higher yielding, which had some sort of regulatory overlay, domestically great, but we continue to explore some of those sort of new infrastructure type businesses.
And in addition to the diversification you can receive from adding new managers and new opportunities that Jonathon just touched on, organic diversification that will happen by virtue of our underlying managers buying new assets. So typically the managers may buy 1 to 2, in a good year, 3 new assets per year. And we've certainly seen one of our global managers, the GDIF fund, purchase some seaports and rail in the US more recently. So we're seeing the organic growth in diversification through our existing funds, as well as looking at potential new opportunities.
And I think, Kane, just if I could add one more, to Nick's point, one of the benefits of this IPIF portfolio of 31 individual investments is the actual, and Nick touched on the word, organic growth. So, for example, Transgrid has a $1.5 billion capex program to fund the interconnector from South Australia to New South Wales. So that's not a competitive bidding process whereby we're trying to buy an asset like Transgrid in privatisation, bidding with the likes of whoever the various counterparties bidding against each other. That's an existing asset in the portfolio, which is deploying incremental capex based on a regulated return. So there's no bid cost risk. There's no, I guess, a competitive auction process other than the negotiations with the regulator. And so an example of that was, what did IPIF do? We had an opportunity to participate in the capital raise. What we've done, what Nick and I have done, is said, well, how do we differentiate ourselves even further? So no one can get access to that investment in terms of the UTA opportunity, but let's take a step further. How do we get a co-investment structure in place for our underlying, for the 30 or 40 investors on this call? And we created a vehicle which basically had a cost structure of around 33 basis points to enable the investors to go direct into that manager to access that organic growth in relation to sort of regulated capex deployment. And another opportunity, if we think about diversification, to your question, Sydney Diesel has a circa $1.5–2 billion capex program to double the size of the facility. UTA in our fund, and that represents a really terrific opportunity for further deployment. Again, we don't have to worry about bid costs. We don't have to worry about acquisition risk and mispricing, because we've held that asset for something like 6–7 years. It's been held by those funds. So there's within portfolio, and again, that's what happens when you've got 31 assets across 4 managers, 80 cents on the dollar, directed in Australia and New Zealand. That home bias gives us some really good insights of where to look at the diversification in assets that are really known and understood by us and the existing managers.
Just leading on from that point, talking about new infrastructure, given the need to stimulate the economy, the monetary and fiscal stimulation provided by the federal government, do you see further nation-building infrastructure initiatives that will need private funding?
Yeah, there's plenty of opportunity for further investment in infrastructure to continue to support the growing population that we have. And the government, through various industry bodies, have identified a number of those projects, and it's close to I think 60 to 90 billion of funding required to support these opportunities. What's happened in the past that has been really successful is what the New South Wales Baird government at the time did with the asset recycling program. Typically, private investors are less willing to take on the risk of these development infrastructure opportunities, because it's usually about building a new road, building a new pipeline, building a new seaport. So there's a higher risk return trade-off there with that type of infrastructure. And they acknowledge that typically private investors don't want to take that risk. So what they did, the New South Wales Baird government did, was look to privatise that had a strong yield profile. Transgrid was the example, and then they used the proceeds, and in the case of Transgrid, and Jono, correct me if I'm wrong, it was about $13–14 billion of proceeds from that deal that the government then went on to use for new projects, new roads, new development. So the investors get the benefit of getting exposure to the Transgrid asset. That asset was purchased by UTA, which is in our portfolio. So your investors and you on the call directly benefited from that, and then the new funding to support the pipeline that's coming. So there's, I think it's support. It depends on which government, which side of the political fence each state sits for those programs to happen. But there's certainly those opportunities that we expect will come over the next 5 to 10 years. And
Kane, to your question as well, I think collectively now with the post-COVID, let's call it the recovery, with balance sheet repair, both at a state and a federal level, I think it's just a matter of when, not sort of if, those recycling programs that Nick's talked about will happen. And bearing in mind some of the industry funds, obviously have great appetite for unlisted infrastructure. And so, I think it could only be described as it'll be highly bipartisan in terms of the support for that. And you're seeing some of the language coming out of Convey and IFM, and similarly the SMSFS crew that have even approached Nicole for her views recently. So there's no question it'll happen. I think it'll be a post-COVID 2021 issue, and there will be opportunities, absolutely.
Okay, thank you. I've got another question from Stuart here. What assumptions are you using for long-term interest rates and inflation?
So in terms of the underlying cost of equity, so they vary down at obviously at the asset level, but in terms of the actual underlying cost of capital build-up, the valuers take the 10-year bond rate. So in terms of building up the cost of capital, and they actually add a premium to that bond rate of whatever the spot is of circa 90 basis points, wherever it is now, and they add about a 200 basis point premium to that hurdle rate in the context of the underlying building up the equity discount rate for the airport, the regulated asset, the toll road, the port. So there is, interestingly, not that I think we've got the issue facing us now, but there's no question there's quite a firewall built into a sudden rate rise profile within each of the underlying assets. And I think, I'll give you an example of that. We're like looking at airports in the event of a sudden quick, a dramatic turnaround in interest rates or an increase in interest rates. What you'll see is the underlying growth rates within the cash flows will be typically increased to match those interest rate rises as they start flowing through the economy. And I think that's where IPIF's interestingly poised. Again, we don't think interest rates are going to jump to in the near term, but it was a question early last year, and I think what you see with some of the GDP linked assets is they're almost hanging around the hoop for that increase, because that increased activity allows them to respond very quickly through the growth in underlying cash flows. So that's broadly sort of my response on, each interest rate, the blended, the cost of debt would be different across varying assets. The regulated assets have got, in some cases, sort of 70, 80% gearing, because they're regulated and predictable, and they are regulated in 5-year regulatory blocks. And in the case of, say, an airport, you've got gearing levels of circa 40 to 45%. So it's all different depending on the quality, the underlying, the underlying volatility of the cash flows.
Great, thank you very much. Just on renewable infrastructure, is there any in the portfolio at the moment?
You've frozen there.
Sorry, if the question was, is there any renewable infrastructure in the portfolio? And the answer is renewable, actual sort of wind farms specifically, or fugitive emission abatement or so on, or solar farms? The answer is no. But what we do have is what we do have is a very strong, I guess, a facilitation role in terms of unlocking those renewable energy assets. If you think about South Australia, so that's got an extraordinary high level of wind invested resource, and the interconnector between Electronet or South Australia and New South Wales to facilitate the transfer of that renewable energy will come through our investment in Interconnect, which is the interconnector to facilitate that. We see that as our version of facilitating our renewable, I guess, our touch point. From our perspective, we've looked at a few renewable projects. We've looked at some solar, we've looked at some wind. We're not quite yet comfortable with the regulatory risk that's wrapped around with some of those opportunities. There's no question that over time that process will mature and so on. But we think there's some better value elsewhere. But we've obviously got a very keen eye for looking at some of those renewable investments.
And I think just to add to Jonathan's point there, those comments probably relate more to the domestic market in terms of the view and uncertainty around some of those risks in regulated opportunities. Is that?
Yeah.
Yeah.
That's right.
Okay, thank you very much. So my internet seems to be dropping out a little bit. Just one last question from me. Can you explain your process of allocating between the underlying fund managers and how you intend to change these relative weightings over time?
Yeah, it's a good question because we are dealing with open-ended, illiquid funds that don't always accept our money when we have it. So we work towards what we call a model portfolio, which is essentially our desired allocation of these underlying managers based on the asset base, and structuring a optimal mix between regulated assets such as the utilities and GDP growth linked assets such as the airports and seaports, for example. And then we try and match that as best we can with deployment opportunities in those funds. Sometimes it requires us to over allocate to those managers at times because there might not be another opportunity within a 6 to 12 month period to get set. And obviously that, balances down as more inflows come in. So it's not an exact science in this space. We have to be a little bit opportunistic, but we do try and work towards a model portfolio.
Well, thank you very much. Unless anyone's no more questions there, thank you very much, Jonathan and Nicole, for your time today, and for everyone attending at home. If you have any further questions, or would like more information on IPIF, please feel free to contact us, and we'll be happy to provide you with this. And please also keep an eye out for another invitation that will be going out next week for our next fund manager webinar, which will be later next month. So yeah, thank you again for listening, and enjoy the rest of your day.
Thanks for the opportunity, guys. Bye-bye. See you later.